right, so welcome everyone. We are, first of all, I want to apologize for our little minor technical glitches, but we're ready to get started. We want to welcome you today. I am Keith Green. I'm your educational director for OCHAR. And today we've been blessed to have a wonderful workshop. We have two presenters working with us today. We have William Bagby and Thomas Gibbs. Thomas is an accountant with Thomas Gibbs, CPA, and William is a financial advisor with Ameriprise. And so what we're going to do today, I'm going to go ahead, I'm going to read their bios, and then we're going to go ahead and we're going to start with Thomas today. Well, again, thank you all. Excuse me, we're going to start with Bill today. William, I call him Bill. He's a longtime friend of mine. So we're going to start with William first, and then we'll go in. No. What do we say we're going to do? We're going to start with.
We're going to start with Tom.
Thomas.
Well,
Thomas
yeah,
today.
and it's actually Ken Gibbs with Thomas and Gibbs CPAs, but Ken.
You know what, Ken? It's been a day. It's Bill's fault. Blame Bill.
Not
for
a problem.
the technical difficulty. So we're going to start with Ken. All right. So Ken, I am so sorry, but let me read your bio, Ken. Ken is, well, first of all, Ken, the thing you got going against you is that you are a graduate of North Carolina Central. That's one of the things, me being an Aggie, but I'm gonna let that go today, all right? So people that don't know, North Carolina A&T State University and North Carolina Central have a long rivalry. Ken is one of the firm's founding partners of Thomas and Gibbs CPA, PLC. He serves as the firm's managing and tax partner. He has an extensive experience in corporate taxation, including compliance, planning audits with emphasis on inbound transactions for multinational conglomerates and handling other controversy matters. Prior to spending the last 20 years in public accounting, Ken served as Director of Taxes and Financial Controller for Glaxo Wellcome Corporation. Ken has served on numerous nonprofit boards such as the Forrester Duke Tax Executives Institute, Durham Citizens Review Board, trustee for North Carolina Central, the Carolina Theater, and the Raleigh-Durham Airport Authority Board, where he was the chairman. 36 years of experience he has. He's certainly qualified. He's a member of the North Carolina Bar Association. He's a member of the American Institute of Certified Public Accountants, and he's a member of the North Carolina Association of CPAs. Furthermore, he's extremely educated. He has a Bachelor of Science in Accounting from North Carolina Central, a Master of Taxation degree from the University of New Haven, and a Juris Doctorate degree from the North Carolina Central University. So I present to you Ken Gibbs. All right, so let's go ahead and get started. There you go, sir.
All right, thank you very much, Keith, for the introduction, and thank the Orange Chatham Association of Realtors for this opportunity to present to your membership. All I had was a pre-pandemic picture, so if I don't look a lot like that picture, that's the reason. Okay, the firm has already been introduced, so I'll just go to that next slide. And I will say this, that we're entering our third decade of being in business here in this community, so we have been around for a while. Okay, so let's talk a little bit about the general information taxation for real estate professionals. So yeah, go to that very next slide that you were.
Can you hear me? Hold on.
Yeah, there you go.
Okay, sorry about that.
Oh, no problem. All right, so when you talk about taxes, we're talking about what choice of entity are you in, because that's going to determine how you tax. Most folks in real estate, you're either there as a sole proprietor, and there are other forms that you could operate in, but as a sole proprietor or a single member LLC. Now, for tax purposes, the default is that a single member LLC will be taxed similar to a sole proprietor. You can go ahead and go to the next slide. All right, so now we're talking about taxes. Which taxes am I liable for? Okay, income tax, federal and state. And there's a reason I made states plural, because if you are operating in more than one state, you will have to pay taxes in more than one state. I've got a couple of clients who are realtors. One operates here in North Carolina, but also is licensed in Georgia. And so she has to file returns in those states, federal, and then in the states that you operate. So income tax you're going to be liable for, and self-employment tax. And for those of you that don't know, so self-employment tax for a self-employed person is similar to FICA for someone who's an employee. So that 7.65% withholding that comes on your paycheck, your employer pays another 7.65%. That total is 15.3%. That is what you are liable for if you are self-employed. You do get to deduct half, but that's something to keep in mind. I threw in business personal property tax because depending upon how you operate, you want to be aware that every county in North Carolina on every January will send out a listing for you to report your business personal property, and that could be a tax that you're liable for. So let's go to the next slide. And I'm rushing just a little bit, but I'll have time at the end for you all to ask questions. All right, and if we look at this slide and go from top to bottom in each column, again, as a self-employed person, you're going to be filing Form 1040 Schedule C. What is Schedule C? Schedule C is the profit or loss from a business. So for those of you who are self-employed, you should be very familiar with two financial statements. One is the profit and loss statement. The other is the balance sheet. If you're not familiar with those, you should try to become familiar with those. So what's the profit and loss statement? Second column says we start with our gross receipts. These are typically going to be reported to you all on a Form 1099. Should be a Form 1099 NEC, non-employee compensation. Those are my receipts. The third column talks about your business deductions. So I take my receipts, subtract out my deductions, I get to a net income that I'm ultimately going to pay income tax and self-employment tax on it. But here's the key thing, that box underneath business deduction, and it really applies to receipts as well, is I need a good accounting system, okay? I really need a good accounting system. So let's talk about that. We can go to the next slide and talk about accounting systems. Okay, so how do I account for these business activities? I know that many realtors that I deal with, some are full-time, some are part-time. Regardless, I advise them all to have a separate bank account for these business activities and to use a separate credit card for these activities, because as difficult as that may be sometimes, if you commingle, and even if you're self-employed, if you commingle this business activity with your personal activity, you're going to have a real mess on your hands. And if you're ever audited by the IRS and North Carolina Department of Revenue, the account that you're keeping this business activity in is in full play. So that would be your personal account as well. So have a separate bank account. Doesn't matter whether you do this activity on a part-time or full-time basis. Talked about an accounting system a moment ago. Most of you have heard of QuickBooks. Microsoft has some accounting products. You can even use an Excel spreadsheet, but do the accounting, because the only way, and again, you can hire a bookkeeper if that's something you want to do. DIY, do it yourself. No problem in doing it yourself if you have the time and the expertise to do the accounting. However, accurate accounting is going to always lead to your best tax position. Okay, so you've got to spend the time doing the accounting to get a good tax position. Next slide. So what are some of the typical deductions for real estate professionals? And you all would be familiar with all of these. Your advertising and your marketing. A lot of that's done electronically these days. You may be paying for a Facebook account. You may be paying for space in other social media or electronic mediums. All of those expenses would be deductible. So you got to keep track of those. And that's where the accounting system is going to come in. Any commissions, if you actually have to pay a commission to another agent or pay a commission, that is going to be a deductible expense. Your office expense should be a deductible expense. Now, underneath office expense, it does say home office. So if you are operating out of your home, you are going to be able to deduct a portion of the cost associated with the home office. And there are a number of ways to do that, but just keep in mind, My office expenses are deductible. These broker desk fees, if you're paying those kinds of fees, then you should be able to deduct that as well. Now, keep in mind, if you're paying this desk fee and you have a home office, these expenses are going to need to be reasonable. Okay, one of those should be your office, but there's an argument to allocate a portion of both. Again, the key is always being reasonable. Okay, so education and training, your continuing education or courses that you're paying for training, those are also a deduction. And this is the big one for realtors, and particularly these days with the price of gas, is your automobile expenses. As you are driving around, taking clients to see various properties, those expenses are deductible. Well, what's deductible? Well, you can either use the standard mileage rate. So the IRS provides a standard mileage rate every year, or you could use your actual expenses. Now, keep in mind when you're talking about actual expenses, we're only talking about the business portion. So if you save every gas receipt that you have throughout the year and bring that to your accountant to prepare your tax return, they're going to tell you or ask you what's the business portion. So it's only that portion. And so mileage is a lot easier most times because you can, I'm sure your appointments are on your calendar and it's pretty easy to determine the mileage. All right, office supplies and equipment, anything that you're buying for the business is going to be deductible. Business meals. Now, don't look at this phrase business meals and forget the business part of it, okay? So every meal that you eat is not deductible. We all have to eat. That does not mean we're going to get a tax deduction. But if it's a business meal, if you're taking a prospective client out to a restaurant, you will be able to deduct that cost. Next slide. Okay, a few other expenses here that are typical for realtors. In any fees, license renewals, memberships in organizations. I don't know, if you're paying for a membership in Orange Chatham Association, that would be deductible. Insurance, right? Your insurance, your error and omissions insurance is going to be deductible. Any software or other business tools that you all are buying, and business gifts. Now, these gifts, we're talking about small gifts, right? Typically, $25 or less, you don't have to provide a receipt. I would not, buy a refrigerator for a prospective client and think you're going to be able to deduct that as a business gift. That it doesn't work that way. Okay, your health insurance is deductible, and it's an adjustment to gross income, so that's better than if you were doing it as an itemized deduction on Schedule A. And then also retirement, and I won't go into that a ton because Bill is going to talk to you again about retirement, but I do say this to all of my clients, and it doesn't matter whether you're doing real estate part-time or full-time, you should be putting money away for retirement. And self-employment is a great opportunity for you to put additional money away for retirement. Okay, next slide. All right, so when do I pay these taxes? I know I owe them. When do I pay them? We're typically talking about paying these taxes on a quarterly basis. So your income taxes and your self-employment tax should be computed together, and you should be making quarterly estimated tax payments. I have people tell me all the time, well, I'm saving up money and I'll pay it at the end of the year. Well, when you do that, you could be subject to an underpayment penalty. So it's always better to pay it quarterly, pay it on time, and so that's when they should be paid. I did throw this in about business personal property tax because that's one that would be due annually if you are subject to that. Okay, next slide. And this is kind of my last slide. So I mean, if you're in business, you're a realtor. So how am I rewarded? These are my big three, right? I'm rewarded by my compensation. That's what I'm earning now. That's what allows me to continue the lifestyle that I'm living now. Compensation. But the retirement piece, I should be putting money away for retirement. And again, particularly if this is a part-time venture, well, I'd say either one, part-time or full-time, but it's an opportunity to put more money away. IRA, Sep, simple 401k, all of these plans are available to you depending upon the amount of earnings that you have. They're tax deductible. IRAs and 401ks can be done as a Roth, so you can do it pre-tax or post-tax. And again, Bill's going to talk about these a little bit more. But then the final one, if you've got a business that you're operating, which is an asset, can I sell that business? Right? So if you build up a nice practice, is it something that you can sell? And so you always, for every business venture, you ought to be thinking of entry and exit. So how do I sell my business? How do I make money on this business that I've built up over the years? So my big three: compensation, what am I going to earn now, my retirement, and then the sale of this business. How can I capitalize on that later? And so that's all I have right now. And I know there'll be some time for questions, I think, after Bill's presentation. So thank you.
Thank you, Ken. Let me set up Bill's presentation. So everyone give me 1 second. Good information, great information. Yeah. Okay, let's go here. All right, so next we have Mr. William Bagby. I call him Bill. Bill is a very dear friend of mine. He's been like a surrogate father to me, and he's my golfing buddy. So I appreciate him coming on today and to share his wealth of knowledge about finances. William, he's an associate vice president and financial advisor with Richardson Private Wealth Advisors, a private wealth advisory practice of Ameriprise Financial Services, LLC. He's been in business 45 years. He has 45 years of experience as a financial professional. Bill's background includes 20 years of commercial banking with the Bank of Boston and First Chicago, followed by institutional investment sales with Fidelity and private wealth management services with Merrill Lynch. In 2009, Bill joined Ameriprise and employed his vast financial experiences to help his clients invest their pre-retirement resources while also helping them to manage their resources in retirement. He holds a Series 7, 63, and 65 licenses and a client satisfaction rating of 5, the highest rating possible. And Bill is a graduate of Norfolk State University. Again, another rivalry of North Carolina A&T State University, so I give him a hard time about that as well. So the next speaking voice you will hear will be none other than William Bagby. The floor is yours, sir.
Thank you, Keith Green. I appreciate the introduction. Let me thank everybody for the opportunity to present to the Orange Chatham Association of Realtors. And Ken, I found your remarks very insightful. I should also disclose to you that Ken and I are friends, fraternity brothers, and also have a professional relationship. So I think my compliance folks would want me to disclose that. But what I'm going to try to do in the next few minutes is highlight some of the individual retirement opportunities that are available to you. Ken briefly mentioned those, and I will talk about them from the 30,000-foot platform. And then through your Q&A, or through our Q&A, perhaps we can deal with a little bit more detail, as everybody's experience, relationship is different. There is no cookie cutter. But I will talk specifically about IRAs, Roth IRAs, conversion of IRAs into Roth IRAs, Sep accounts or simplified employee plans, and briefly mention maybe KIOs. So Keith, if you'll start my slideshow.
Okay, it's up.
Okay. The first thing is as Ken mentioned, retirement is one of the, or retirement saving and investing is one of the ways you compensate yourself for this business endeavor you're in. And these points here are that you can't start too early. The sooner you start, the more opportunity there is to accumulate investments towards retirement, the more opportunity there is to articulate between the investments that you make that will be pre-tax income investments versus post or after tax. Roth is primarily what we mean there. And you'll also have more time to experience the various investment cycles of the market, because the market is very volatile. But it's amazing with consistent saving and investing, the opportunity to accumulate. And we need to do that for a couple of reasons. Number one, people are living longer. For most of us, statistically, we'll have at least 20 years in retirement after we retire. And so you need to start to accumulate today for those anticipated future expenses of whatever lifestyle you choose. Next slide, Keith, please. And so the question becomes, what is best for you now? A traditional IRA or a Roth IRA? So let's talk about some of the components of each. First of all, I started with a general assumption that most of you are either full-time, individually employed, or part-time. That should not necessarily negate that there may be many of you or some of you who've had previous employment experiences and may have a 401k or a 401(b) in your investment portfolio. If you do, or if you're still working part-time with a corporate employer that provides those retirement opportunities, I cannot encourage you more than to invest in those, because typically those provide a matching in opportunity from your employer. Or if you have left the primary employment and have left behind a 401k or a 403(b), there is an opportunity for you to convert those or bring those over into your own individual IRA. So having said that, let's talk about these traditional IRA versus Roth IRAs. The first difference is, for most of us, the opportunity to invest in a traditional IRA will be a pre-tax deduction. In other words, you can put that money into an investment vehicle and take it off of your gross taxable income. Versus a Roth IRA, we're looking at having paid taxes on money and we invest that. The advantages are several, one versus the other. It really is a lifestyle and where you are in your life cycle issue. For a traditional IRA, depending on your age, you can contribute up to $6,000 or $7,000 a year as a pre-tax deduction. Comes right off the top of your gross income, as Ken has indicated. There is no age limit when it comes to withdrawing that money. This is where a key distinction comes in. The IRS will say to you, Mr. and Mrs. Jones, you have this opportunity to put $6,000 if you're at the age or under the age of 50. If you're over 50, it can be $7,000. And when you do, that money can grow tax deferred for you. In other words, your dividends and capital gains will continue in a tax deferred category. You won't be subject to any income taxes on them. Your investment company will report it to you annually. You'll report it to your tax preparer, but there is no tax liability up until you reach the age of 72. It used to be 70 and a half, and then last year that was changed with the pandemic and the economic impact of that. The government thought that we ought to need a little bit more time because of the economic and financial situation that we were in. So for a variety of reasons, the required minimum distribution is what it's called, was reset now at the tender age of 72. So for traditional IRAs or 401ks, 403bs, when you reach the age of 72, the IRS will say to you, congratulations, Mrs. Jones, you reached this age. Now you have to start taking money out of your traditional or your retirement resources. that have heretofore been tax deferred. It's done on an actuarial table, and typically it's about 4%. So if you had, let's just use a number. If you had $1 million in cumulative qualified, is what they're called, qualified accounts, meaning they qualify for tax deferral at the end of a calendar year, then 4% of that, or what, $40,000, you got to take out each year when you get to be 72. If you don't, there's a 50% penalty. When you take it out, you'll pay ordinary income tax on that. So that's the tradition. Key difference with the Roth is, with the Roth, you're putting money in after tax, so you pay taxes on it, or you can put money in pre-tax, and if you hold it in the Roth for 5 years, or you convert from a traditional into a Roth and hold the funds there for 5 years. Then there is no required minimum distribution. You can take the money out at any time, you pay taxes on it, and you hold it for 5 years if it was a pre-tax situation or a Roth conversion situation, and you pay no taxes. So the question for most of us is, do I think my tax rate is higher pre-retirement or post-retirement? That's the issue. For me, I like to defer taxes. I don't want to pay taxes until I have to. So for me, it's an easy question. I would rather take my pre-tax deduction in this example that I've talked about with a traditional as opposed to a Roth. I discourage folks, depending on the situation, even to convert into a Roth, because you're paying the taxes now on what you convert. Again, for me, I like to tax defer. Ken tries to keep me honest. Thank you, Ken. But that is my personal preference. Next slide, please. We can go that one. Skip that one. Okay, let's come back to this. Well, we can hold it. In this tax, we call it the cash triangle. And what this says is, when you reach retirement, you've got 3 buckets to draw from. And what you want to do is to pull from these buckets in terms of cash withdrawals in the most tax efficient way. And so the first tip of the triangle here, the dark blue portion, is what we call tax-free. And tax-free accounts like your savings account, your money market account, these are things that you have put money into that were, pre-tax money. And you're going to get a 1099 on these things every year. If you've got a money market account and you've made some interest income, you'll get a tax 1099. You'll have to report that as taxable income. You have also this taxable portion here of the triangle, and those will be things like brokerage accounts. So you've got some securities that you've invested in, or you might even have mutual funds that are in non-qualified, meaning they don't qualify for tax deferral. And so these are taxable, and you're going to get a 1099 on those. And then the third pocket will be your tax deferred. These will be your 401ks, your IRAs, your Roth Iras. And so what we at Ameriprise say to you, and everybody else does too, when you get to retirement, look at your 3 pockets and pull money from in the most tax efficient manner. Okay. And so with that, I'll just touch briefly on other individual retirement opportunities. There's something called the Sep Account, which as a self-employed individual, you have that opportunity. Thank you, Keith. Go to the next slide here. And so Sep accounts work very similar to IRAs and Roth IRAs, except that they're a category which will allow you to put aside for retirement a larger number. So with a Sep account, you can do as much as 25% of your gross earnings, or up to, in case of 2022, about $62,000. So if you've got a revenue base that will allow you to open a Sep, as opposed to the restrictions of 6,000 or 7,000, depending on your age, in either a traditional IRA or Roth IRA, go with Sep account, because here you can put aside a considerably larger amount of money for retirement and enjoy the tax consequences of that. There's also, for professionals like doctors and some lawyers, the KEO, which is really the forerunner of the Sep account. And so generally, those are the kind of investment opportunities available to you. I'll stop now. and allow you to ask questions of either Ken or myself. If time permits, I do want to make you aware of something called 529 plans, because I suspect many of you have children, you may have grandchildren, and this 529 savings for in future education is the greatest thing since sliced bread, as they say. But Keith, I'll end my remarks there now.
Go ahead and talk a little bit about that. Get about 5 minutes to talk about that, and then we'll go to question and answers. If you want to go ahead and talk about it.
All right, fair enough. Okay, so it used to be, before 529 plans, I'm talking 20 years ago.
With Ameriprise.
Somebody's.
Go ahead. I muted. Go ahead.
Okay. So it used to be that the old Uniform Gift to Minors Act was how we put money aside, or something called Coverdale, which is essentially a savings account. The problem with those plans was, and currently still is, that once the child reaches 18, the money is theirs, right? You're putting the money aside as a parent or a grandparent with intention that Johnny Jr. is going to go to college. Well, at 18, the money becomes Johnny Jr., and he or she can decide what he wants to do. And they may decide they want to go out and buy that little red convertible and not go to college. And there's nothing you, the parent or grandparent, the person funding the account, can do about it. And so about 15, 20 years ago, Congress and the Department of Revenue came up with this idea of the 529 plan. And so the distinction here is that under the 529 plan, the actual funding of the account and the ownership of the account, the key is the ownership, resides with the person funding the account. So if it's a parent or a grandparent, you own the account. The beneficiary is the intended child or grandchild or niece or nephew, right? But the money doesn't pass to that beneficiary. The money only goes at the direction of the account owner. And when you save it, it's tax deferred. You pay no taxes on it. If indeed it's used for an educational cost, it's tax free. So what are educational costs? Tuition, room and board, computers, foreign travel, anything related to that typical young person's college education. New entry in the law, I can even, at 74 years old, start my own 529. And if I decide I want to use it for some continuing education, it can be used for me too. The other thing is these things are flexible, right? So if I have two kids and one of them is exceptionally bright and gets a full ride, even if I put money aside, put in that child's name, I can redirect it to the second child or to a niece or a nephew. So it's flexible. So you have ownership resides with the contributor. You have flexibility in terms of being able to move the money. You have the tax advantages of tax deferred and ultimately tax-free distributions for any cost, virtually any cost related to education. And those are the tenets of the 529, so much better a way of investing and putting and saving for a child's education. I'll mention one other thing, and that is these things are ideal for grandparents because unlike the financial statements and disclosures that have to be made if you're applying for college tuition assistance for your child, your 529 plan contributions for a grandparent won't have to show on that financial application. For a parent, it does. So it's a great vehicle for aunts and uncles and grandparents. And lastly, I'll say every state has its own, it's all like Medicare, has its own administrative component for 529 plans. In the great state of North Carolina, they're called non-brokered plans. So you don't buy them through someone like me who gets a small compensation. You would go directly online to North Carolina plan 529 plans, and you would buy your own. So in other states, typically where a lot of my client base is, I am compensated for it because I do advise on these. Now, having said that, because they are investment vehicles for higher education typically, which now can include private school, high school, junior high school, there are restrictions around the investment asset categories. I cannot take 529 money and go buy, Google stock, no matter how great I think it is. There are prescribed portfolios, which as the child ages becomes more equity weighted, more stock weighted. I should say just the opposite. As the child ages, becomes more conservative in their asset allocation, moving away from equity or mutual fund stock investments into more fixed income and cash, because it's anticipated that is when you'll be drawing on the plan. And so the idea is to reduce the potential volatility of the investments. So there are about a half a dozen or so pre-described, predetermined asset allocations for these accounts. A lot of words. If there are questions later, we can talk about that. But I'll stop right here, Keith.
Appreciate that, Bill. Thank you, Ken and Bill, for your presentations. So if you have a question, raise your hand or type it in the chat. So the first question I have is from Tim, and then he says, if you have royalty and rental income in another state, and he says $5K in oil leases and royalties, do you pay in both states?
So yeah, Tim, the answer to that is yes. Now, what happens is if you're in North Carolina and you're receiving income, let's say from a lease in Louisiana, you'd pay tax on it in Louisiana, and you would get a credit in North Carolina for the tax that you paid to another state. So it's not really double taxation, but it is reporting in two states.
Another question was self-employment tax. If you're over 65, do you pay this?
Yeah, so there's no age limit in terms of paying the self-employment tax, or if you were working as an employee, having FICA withheld. So if you've got earned income as a self-employed person, you'd have to pay the self-employment tax.
Okay. Other question is, if you have a refund, do you recommend putting funds towards next year's estimated taxes?
So I would say this, yes, to the extent that it reduces next year's burden. In other words, many people, if you're filing your taxes, let's say around April 15th, and you've got a refund and you're self-employed and you have a payment due to the IRS on or about April 15th, you might as well let the refund apply to next year. The other thing with that is if you paid your taxes after April 15th, and I'm talking about the estimated taxes now, it could be considered late, but that refund that you're applying would reduce any potential penalty. So I'd say, yeah, it's typically a good idea to do that.
Okay, all right. Any other questions? Don't be shy. You can unmute yourself, ask the question, send it in the chat, or however you want to do it, or raise your hand, I recognize you. Any other questions out there? Wealth of knowledge, wealth of information here on the call. So if you have any questions about anything, Tim, go ahead.
Yeah, I apologize. I got a call the minute y'all started talking about the questions, but if you get income from one state, do you pay for the income in both states, like Louisiana, North Carolina? That was my first question there.
Yes, and Tim, what you do is it is reportable in both states.
Okay.
But if North Carolina is your home state, you should get a tax credit in North Carolina for the tax that you paid to another state. So it's not double taxation, but it has to be reported in both places.
Yeah, it's not a huge amount, but I just didn't want to get dinged. So.
Yeah. Mm-hmm.
All right. Tim, any other questions, Tim?
Well, I missed the self-employment tax over 65 as well.
Okay.
Yeah, there is no age limit for paying self-employment tax. If you have self-employment income, you will pay self-employment tax. That's correct.
Thank you so much. Really appreciate it. Thank you all for the presentation. It's been great.
Oh, you're welcome.
Another question was, explain how to pay taxes on the Roth versus the traditional.
Sure. First of all, everybody gets annually the opportunity to contribute up to $6,000 in the event you are under the age of 50, or $7,000 as a catch-up, it's called, every year. Now, you can't do both. You can do one or the other. So the question is, if you want to take a pre-tax deduction and invest in a traditional, meaning if, just to make it simple, you make $100,000, you can take $7,000 off the top of your taxable income, reportable taxable income, and report only 93,000 because that 7,000 is going to go into a traditional Roth, or you decide I'll pay the $7,000 tax and put it in a Roth account, which will be an after-tax contribution into a Roth. So that's the tax question for you, putting money in to one or the other. Now, the consequences are with the withdrawal. If you put the $7,000 into a traditional IRA, you will enjoy a tax deferral until it comes time that you either you elect to take money out of it, a voluntary distribution. And when you do, the earnings on what you have contributed will be subject to ordinary income tax. That's dividends, capital growth, etc. On the Roth, you put money in, as we said, after tax. If you hold it there for 5 years, you can take it out, you can withdraw it. And when you do, there's no ordinary income tax or reportable tax liability. Why? Because it was after tax money. You paid the taxes on it before. And as I said previously, there is no requirement at the age of 72 to have to take money out under this required minimum distribution. Can't hear you, Keith.
Thank you all so much. Any other questions? We're getting a lot of thank yous and excellent jobs in the chat. And I'll definitely share their presentations with everyone on the call, if that's okay with Ken and Bill. Is that all right for me to share the information? And
Sure.
Absolutely.
Okay, thank you. Their contact information will be on the information that we'll have Cubs sent out. Everyone is saying it's been very helpful, that they're thanking you. Any other questions from anyone? Don't be afraid to ask questions.
I have one more about the
Go ahead,
Roth IRA. I'm still not understanding. So if you hold the Roth IRA for 5 years, you can take it out and not pay taxes on it because you've already paid taxes. But is there an age limit on that, or any time after the 5 years, or do you have to be a certain age to do that?
No, you don't. The answer is yes and yes. Yes, you can put it in. And after 5 years, yes, you can take it out with no tax liability on what it's earned. And there's no age limitation.
And you can use it for anything.
Yes, ma'am. That's correct. Now I should go back for a moment to one advantage, since you raised the question of using it for anything. One advantage of the traditional is that you can, under certain circumstances, take money out of that. For instance, in your field, to buy a house, right? You can take a withdrawal from your 401k or your traditional if you're going to use the money to purchase a house or part of a down payment on a house without a tax liability. But otherwise, you stated it for a Roth. You got it. You put after-tax money in, it grows tax deferred, and after 5 years, you take it out tax-free.
So even on a 401k, I can still take money out to purchase a home without tax liability?
That's right. On a 401k, that's right. You can do a withdrawal, and if that money is going to purchase a home or pay for healthcare expense, you have a spouse or even yourself, you've got some medical issues. There are exceptions, or I guess Ken would put it, exemptions to withdrawals from a traditional or 401k for certain expenses.
Yeah, and there are exceptions, as you said, and what you're trying to do is avoid the penalty. One thing about a 401k, and I always tell people, look at your plan, because if your plan has a loan feature, it
Right.
may be better for you to take a loan than to actually take money out, because you can, if you're below 59 and a half, you can end up with a 10% penalty. So if you're using the loan feature, you're getting the money, you're repaying it to your account with interest, which takes into account the growth that you would have missed. So always look at the plan provisions
I couldn't agree with you more, Ken. Every plan has its own provisions. One editorial, if you will, if you were using the proceeds for an exempt expense, tax expense, I don't think you're subject to the 10% regardless of age, Ken. Would you agree?
I would, yeah. But again, you definitely want to, here's what I tell people to not do. And this, I'm not an investment advisor, but when the market drops, people many times want to run and take their money out. And from an investment standpoint, that would be the time to leave it in because the stocks are actually cheaper. But if you're in the market long enough, and Bill hit upon this point, there are going to be some ups and downs, but over time it continues to grow. So
thank you for that, Ken. That was unsolicited. That was unsolicited, but appreciated.
I felt like you were thinking that.
All right, great information. Louise, did your question get answered, Louise?
Yes, thank you. That was very
Thank you.
good.
Thank you. Any other questions? Do not be afraid. We have time. Got about 4 more minutes.
Again, I hammered a little bit on the accounting part, but again, I've got clients who are realtors, and if at the end of the year you're scavenging for monies that you spent during the year, you're not going to get your best tax result. Okay, so you've got to spend a little time with the accounting. That separate account is a better way of accounting for it. You're not commingling with others, but I know people like to say, well, what tax planning ideas do you have? And my best tax planning idea is to keep good documentation, because then you could actually take advantage of those deductions for money that you spend.
I have one more question. Ken, you're the CPA, right? Or is it Bill? No, it's Ken, right?
Yes. Mhm.
If somebody is looking for a CPA and needs to get 2021 filed soon, are you got spots open?
Well, if you define soon as before April 15th, I would say no.
Okay.
But what we would do is we would file an extension and get it done as soon after that as we can.
Yeah, I had a disaster where my CPA of over 40 years forgot to file 2018
Okay.
and screwed up filing 2020 taxes. And then he finally told me he's going blind. So I'm in desperate need to get my refund that I was owed in 2018. They say I need to get my taxes filed before April 15th. So I'm kind of in a squeeze. So
yeah, that is definitely correct. That 3-year statute, you'd lose it if you didn't get it done before April 15th.
well, I've got that one refiled. Hopefully the IRS advocate is pushing it through the system. But I mean, he literally hadn't even apologized for screwing it up.
Ken can help you out there, Tim. I will make sure you have Ken's information. I don't mean to laugh when you said the man went blind. I'm so sorry to hear about that, but, but Ken's not going blind. Ken can help you out there. So
don't commit for Ken. He can commit for himself. But anyway, thank y'all for putting this program together. Do appreciate it.
No problem.
You're welcome.
Thank you for attending. And if you guys, but I am volunteering their services, but in reality, these young men that we have with us today, Ken Gibbs and William Bagby, are more than happy to talk with you. Of course, it's the middle tax season for Ken, but like he said, there's gonna be some time after that where he can talk. And then he's got a staff of people that can help you as well. Both of them do. So whatever your needs are, I'm sure they can meet those needs. So other than that, God, we thank you guys for attending. William and Ken, we thank you all for presenting. It was a wealth of information. It was great information, and we really appreciate you. Before we go, are there any last questions?
Can we get their information?
Yes, ma'am. I'll make sure Cub sends that out along with the
Thank you.
presentations today. And we thank you all for attending. All right, with
Happy
that
to do it.
Yep, absolutely.
Ken, Bill, thank you
Take
so
care.
much.
Thank
You
you.
guys
Have a great week.
We'll be in
Take care.
contact. Have a great day. Appreciate you.
You too.
Thank
Bye-bye.
you.
Bye-bye.